Hello, I'm Greg Bunnell. Welcome to Market Call tonight. Our guest, Kim Bolton, Portfolio Manager of Black Swan Dexteritas. He's taking your calls, emails, and tweets on technology stocks. So give us a call. It's toll free. 1-855-326-6266. You can send an email to marketcall@bnnbloomberg.ca or tweet us at marketcall. Welcome to the program. Kim, great to have you here. First time you and I have done this together. Your second time on Market Call.
That's right.
All right, so maybe viewers might not have caught your first appearance. Let's just start with sort of your investment thesis, how you go about picking and investing the stocks that you're currently invested in.
That's great. Thank you very much for having me. I manage a technology fund in the publicly traded space. The name of the firm is Black Swan Dexteritas. There's a story behind it, but it's all about prosperously navigating unexpected events with great skill.
Okay, because when you said prosperous, and I thought of black swan events, we all as investors know that you fear the black swan because you don't know what that event's going to be.
Black swans can be good things. They can be unfortunate.
Always opportunity. Depends where you're where you've put your bets.
Yeah. That's right. We started it off, the Black Swan Dexteritas, back in 2013, and it really evolved out of some serial entrepreneurs came to me. I had managed a number of portfolios during my career, and these young serial tech entrepreneurs, long story short, asked me to actually manage their publicly traded portfolio. They had their own private companies, they had their own venture cap and their private equity side, and I was to be their eyes and ears into the publicly traded space. And it's worked out tremendously well in such that it is I actually give them insight into what big publicly traded companies are doing, and they give me insight into where they're making the money.
Okay, so that's a very helpful insight on both sides. I know you brought along some, not really charts, but sort of pictographics about sort of further flush out your philosophy. What does this first one tell us? Digital business is at the hub of it all. I see a lot of big tech names around the pie. What is this telling us?
Oh, okay. We use this chart actually in talking to people because it has the logos of a number of publicly traded technology companies around it. You can see the bullseye. The whole technology space in its simplest forms is all about digitalizing business. And then, so that's the bullseye. And then there are three trends going around that. One is going from 12 o'clock to 4 o'clock, which is all about the merging of the real world with the virtual world. The green area from 4 o'clock to 8 o'clock is about business intelligence, data analytics, and so on. And then from 8 o'clock up to 12 o'clock is this theme of electrification and digitalization. And then that outer circle actually has 10 trends.
Or the trends that fall in. So an example there would be the intelligence everywhere portion at the bottom of the chart. AI and machine learning is one of the components of that.
Correct. So down in that green area, there's the digital content. And one area that I'd love to talk about tonight is in gaming. Because gaming went through sort of a hype cycle and is now becoming a real business out there. And you can see it by some of the big mega cap companies actually participating in it. And then that area of the advanced analytics and AI and machine learning, that's really very much the evolution of Excel spreadsheets. You know, Excel spreadsheets started out.
Excel spreadsheet.
And then how it actually, companies like Tableau and Splunk actually took it from spreadsheets and put it into dashboards. And then you went into the whole algorithms and machine learning and artificial intelligence, which the mega cap companies have spent an enormous amount, billions of dollars, in getting patents. It's still a bit in a hype cycle, and the monetization of that machine learning and artificial intelligence will probably come about in about a year and a half to 3 years.
Okay, excellent start to the program. We're going to take a quick break and then be back with Kim Bolton, Portfolio Manager of Black Swan Dexteritas, answering your questions about technology stocks. So give us a call, toll free, 1-855-326-6266. And if you're listening to us on the radio, I'm going to repeat that number one more time because you can't see it on the screen. It'll be 1-855-326-6266. Get things started. We have a viewer from Regina who wants to talk about Taiwan Semiconductor. Your opinion, please, on the name going forward.
Thanks, Greg, and thank you from
The
Regina?
viewer, I'm not sure if the viewer is from Regina or the viewer's name is Regina, or perhaps the viewer is Regina from Regina. But anyway, we got something from
Okay.
someone named Regina.
Taiwan Semiconductor. You know, it's actually been hurt recently. This comes out of Taiwan. They're one of the main assemblers for the smartphone market, certainly for Apple. And you can see that it's actually come down recently. It's getting close to that level that we're sort of saying around that 35 to 36. They very much have a monopoly on, well, a leadership, may I say, in the assembly side of the smartphones.
Are these the kind of companies we worry about then, as China and the Americans go head-to-head on all manner of products, but definitely technology seems to be a sore point for the Trump administration, and you get these companies, is this the kind of company that gets caught in the crossfire of a global trade war?
Well, it does in terms of the market. Mm-hmm. You know, if you look at the Chinese market, my gosh, it's down anywhere from 17 to 20% this year. Whereas you look at the NASDAQ and it's up 9 to 10%. And then you look through Europe and it's sort of down anywhere between 4 to 7%. So certainly the market dynamics in the region will affect the individual single stocks. And a great example here is Taiwan Semiconductor. Now there's quite a bit of discussion on what happens for the remainder of this year. If you go into the beginning of the year, a lot of the fund managers out there had sort of, last year we had a great year here in North America, and they sort of took some profit and placed it over and geographically diversified. But that didn't work out, and so it'll be interesting going into the third quarter on whether there is a repatriation, put it back into the U.S. markets. Our opinion is it's best to have that diversification around the world.
Okay, we're going to take a call now. Michael in Vancouver. What's your question?
Greg, thanks, Kim, for taking my call. Kim, one of the big ones, Microsoft. I've had some bumpy rides with it when I first bought it, but it's been very, very a good riser over the last few years. Just wondered what, if you owned it, and what you think of it going forward. I've got a lot of patience, so 3 to 5 year horizon would be what I'd probably be looking for. Thanks so much, Kim. Greg, I'll hang up and listen to your response.
All right, thanks. Microsoft, yeah, it's had a great run. I guess the question is, what happens from here?
Well, we have about a 3.5% position in it. It has such a solid franchise. But with a lot of these companies that may appear rich, it's all about the runway that they have in front of them. And a great example, Greg, of how Microsoft actually extended their runway recently is with that acquisition of GitHub. And GitHub actually molds well with Microsoft Azure, which is their cloud platform. So in the cloud space, you know, Amazon Web Services really controls around 70-75% of the cloud space. And then behind that sits with Microsoft Azure with around 18%, and then you have Google and then a sort of small ones beyond that. Microsoft went out and bought this GitHub for $7.25 billion. And it really enables them to extend their runway into the cloud space, especially allowing business-to-business communication on the cloud, which was a very, very smart. Maybe it was expensive, but into the future. And besides which, you know, a lot of these companies, they repatriated so much money overseas. So they have only so many things they can do. They can pay it out in dividends, they can do it in stock buybacks, or very smartly, Microsoft went out and bought GitHub for $7 billion, which was a mere pittance in the amount of money that they actually brought back.
Yeah, Still rolling in that stock. Year to date, Microsoft is up 19%. We have Sanjay in Ottawa on the line. What's your question, Sanjay?
Guys, thanks for taking my call. My call is for Nutanix. I wanted to get your guest opinion and some insights on this. Given the cloud is really in the forefront, and most companies are exploring the cloud. Nutanix is also in that space. Also, they're providing a technology from both cloud and on-prem perspective. So, what do you think going forward prospects for this company?
All right, Nutanix, what do you think?
Thanks, Sanjay. This is a bone of contention for me, actually.
This company?
Yes, because we have this investment committee that is really sort of an ideation. You know, we cover 718 companies that we get financial data on publicly traded technology companies around the world. Now, if you go back to that circle diagram, what we're using this investment committee to do, and this is long story short to get to Nutanix, Sanjay, is that the investment committee gives us insight in their private businesses of where they see the investment opportunities. We have a couple of guys on the investment committee that are retired Cisco executives, and they actually showed this to me about 2 years ago. And Nutanix was actually trading down. I remember when it was down in the low 20s, and we actually bought 1% at 22. We were going to buy another one at 20 and another one at 18. And I think here it is up at 53. It's been up all the way up to about 56, 57. It is on the forefront within the cloud. And Sanjay, I know you probably know, but for the rest of the viewers, what Nutanix does is they're involved in, and you know, technology has all these acronyms, but Nutanix is involved in the software side of the cloud. So the cloud is all about taking servers out of company and putting it in data centers and making it more efficient, more economical for companies to actually have it in a data center and in a cloud environment. It makes so much sense. But the problem in the past is that companies, vendors were always coming out with new hardware. What Nutanix did is that they got involved in this thing called hyperconverged infrastructure. And it's, in its simplest terms, what it is, it's software for the cloud. And it actually allows the hardware in the cloud, in the data centers, to actually be upgraded via software. And this is exactly what Nutanix did. The reason it's a bit of a bone of contention for us is that we had a great plan to actually build it up to 3%. It actually got up to about 3.5% just by the growth of the stock. But unfortunately, we bought it at 22. We wanted to buy it at 20, never saw it. But it's worked out very well for us. Right. So at this stage, at 53, we're still holding. We have a price target, a 12-month price target of 68. And so I would hold it. I don't know if I'd buy. I wouldn't buy more here. I'd try to get it back in sort of the high 40s.
Right, maybe wait for a pullback on that one. We'll be back with Kim Bolton, portfolio manager of Black Swan Dexteritas, answering your questions about technology stocks. So give us a call. It's toll free. 1-855-326-6266. We have Dominic in Markham on the line. What's your question, Dominic?
Thank you for taking my call, gentlemen. My call is concerning Snap. I bought Facebook back in the day for $40, and I can't go wrong with that. But I think Snap, since its IPO, has gone down quite a bit. I'm just wondering, would you buy it up now or continue to let it drop first before you buy it? Thank you.
Snap. What do you think of Snap?
Thanks, Dominic. We did own it. And then they disappointed on their previous earnings. We made some money. You know, in that disappointment, we actually left some money on the table. The proceeds of when we sold Snap, we actually put it into Twitter. And you know, so I would recommend, rather than buying Snap, I would recommend, Dominic, Twitter. And certainly after today's
Yeah, we ended up
sort
about
of
5.5% down on those concerns that they're purging tens of millions of their accounts. And
It
it's
was
going to play
ridiculous.
on the metrics.
Yeah, it was ridiculous.
Yeah, but Twitter actually did. I think they didn't came out and said, "Don't worry, those accounts that are being purged, this isn't part of the metrics that you're trading the stock off of." So I guess the market will decide eventually whether they buy into that or not.
Well, the implications of that, you know, Twitter has, 336 million monthly active users. And the Washington Post article actually came out and said that they had purged 70 million of the 336.
So that's a huge percentage.
That's huge. And so it's no wonder that, you know, sort of late morning today, it was down 11%. And then Ned Siegel, the CFO, actually tweeted and said it was very, very misleading. What they were purging was actually some fake accounts, some bots that were coming in, some sort of sketchy accounts that were being set up for nefarious reasons or whatever. And they said they actually didn't even count that in the monthly users. And so it actually recovered about half. But people are very, very suspect. I think it's a great opportunity. We've owned Twitter for, look at an average stock price down in the teens, $17 or something on that. But, you know, Twitter is up 140% in the last year. But it still has an extremely long runway. I could go at great lengths of how bullish we are about Twitter. But anyway, Dominic, I'd recommend, if you're interested in that space of the social media space, rather than Snap, you look at Twitter.
Okay. Deborah in Okanagan Falls. What's your question, Deborah?
Oh, thank you for taking my call. I find you extremely fascinating. You're just full of information, and you explain things so well. My question today is on Intel. Mm-hmm. I read an article that Intel's strategy, they're having a strategy to broaden their data center product portfolio, and I wanted to know if you thought that was reasonable, and how do you see the future of this company, and is this a good stock? I bought it just below, I took half a position just at and around the $50 mark.
All right,
okay.
Intel.
Intel. You know, to us, Intel is very much a core position, but we sort of trade around that core being about a 3.5% position. We let it appreciate it, take a little bit of money off, and then look to buy it down below. But we always sort of hold Intel. You know, we have the great fortune of working with a lot of very successful and smart tech entrepreneurs. And as they always say about Intel, they're quiet, but they're a leader. And what they've really done lately in the last couple of years, is that they've been very much warming up to again the cloud, and being a vendor of chips into the cloud. You know, there's a lot of talk out in the marketplace about Apple replacing Intel, but that's not really until like 2020. So we have a couple of years in that. We've always found that Intel ultimately is successful and a leader in what they do. And particularly, we believe in their supplying over into the cloud, they will be a leader in that.
All right, Intel, thumbs up for Intel. We're going to be back after a short break. Past picks coming up next. Time for past picks because Kim is fairly new to the show. We're only going back to last month, June 1st, 2018. You liked Dassault Systems at the time. Do you still like the name, and does the thesis still hold for putting money into it?
Absolutely. That's the return on up 0.4 on the month, but if you actually go back over a year, it's up.
It's had a great 61% past year.
Yeah, and since the beginning of the year, it's about 35%. Just to sort of as a little background, this is all involved in the digital twin space, which is all about producing avatars, taking real objects and creating a virtual replication on your screen, and then you can actually sort of fiddle with it. Dassault is well known. They actually did the Singapore. They did a whole digital twin of the city of Singapore.
Oh, really?
It's fascinating. So yes, we still love it.
All right, as far as the street's concerned, let's pull that up. On Dassault, 11 buys, 10 holds, and 3 sells. The next pick was Infineon Technologies. Hasn't had a great month. Again, it's a short time span. But what's going on with this one?
It's down 7% on the month. You know, to me, that's not that surprising, because if you look at the DAX, that's what the DAX did last month. And this is
a German company.
This is a German-Dutch company, and they're in the perfect spot. So this is a great buying opportunity. And what Infineon does, they're the number 2 supplier of automotive sensors in the world, in automotive products and in power discrete solutions and sensors. So it has a long runway. They have leadership there. So yes, we still very much like it.
Street likes it too. 22 buys, 5 holds, and 3 sells on Infineon. Our last one is Tencent Holdings. Tell us about Tencent and if you still like the name.
This is down 2% in the last month. One would actually imagine that it would be down more than that, because it's one of the big mega cap companies on the social media, internet software. It's involved in social media, online games, advertising, cloud services. It is one of the monsters that come out of China, and we very much consider it as a core holding. You know, sort of Tencent, Alibaba, Baidu, you know, those bat stocks out of China.
Now, one of these names, and I can't remember exactly, there was a way, Fortnite. Fortnite's a huge video game with the kids. My kids spend way too much time on it to the detriment of their grades, actually. That's a true story. I'm trying to rectify that situation. But someone was telling me there's one of these companies, even though Fortnite itself, you can't play it directly. Was it Tencent, or I'm trying to rememmer now. If someone had a stake where I could perhaps make some money off my children's misfortune.
Absolutely. Tencent actually has a 23.5% stake in Fortnite.
Oh, there we go. Yeah. So it is Tencent.
Yeah, and so Tencent is, and we can talk a little bit about it later. It's on one of their business units is in the gaming, and so they're involved in the publishing and very much in the distribution. And gaming is, gaming is a $120 billion business around the world. Almost 60% of the gaming revenues come out of China. And here you have one of the major players who has an interest in Fortnite, but is also a distributor and a publisher in that space. It's a great story.
Yeah, I think I'm going to set up a system where every hour of Fortnite they want to play, they have to put some money aside to buy 10-cent shares, and maybe that'll work out for them. Back after a short break, our number 1-855-326-6266. We're taking questions about technology stocks. We have Eugene calling from Maple, Ontario. What's your question, Eugene?
Thank you for taking my call. My question related to Adobe, ADBE. NASDAQ. I would like know potential for this stock for next 2-3 years. Thank you.
All right, Adobe's had a nice run in the past 12 months, up 75%.
Yep. Thanks very much, Eugene. We don't own it. This is a stock that plays within the sort of the creative and digital media space. Currently trading up at 240, 250.
249 at the close today and change, almost 250.
Yeah. You know, it's reasonably priced because the PEG ratio is actually down at about 1.34. So it's actually not too badly priced. We have actually we do our own proprietary research. Our price target in this is $250, so we see it as being sort of very evenly priced in here. If it comes down to sort of that 220, 210, that is where we'd buy.
Okay, Adobe, what does the street say? Out of curiosity. 19 buys, 11 holds, and 0 sells on Adobe. We have John in Unionville, Ontario. What's your question, John?
Good afternoon, guys.
Hey, John.
I'm 57 years of age. I'm looking for 2 tech stocks that you could suggest that that have growth opportunities, but also have a 4 to 5% dividend. So if you were to pick 2 to talk about, which 2 would it be, taking those variables into consideration? Thank you.
Okay, thanks, John. And I'm going to make this extra difficult for you, Kim, because you can't choose your top picks. We have to save those for the end of the show.
Okay, yeah.
So something outside of those 3 top picks.
Yeah. John, it's a difficult question. However, it is answerable. Because, you know, technology is a growth space, and it's not really a place to actually look for income. However, one that comes to mind is Cisco. Now, Cisco is trading right around that sort of 42 level. We have about a 3.5% position. We own it at about $37. If I remember correctly, Cisco has, John, unfortunately, it's not 4%, but I think it's right around that.
A little north of 3% now, the yield,
yeah.
This price.
And so that is one that I would, that I'd recommend.
Okay. Another one? You can stop at 1 if you want. You're only supposed to get 1 stock per call, but if you got another...
I'll answer it 2 ways. The other one, I guess, would be IBM. Mind you, we don't own it. However, they are turning it around. IBM trading at about 143. We're a hedge fund, so we always sort of buy IBM down in the low 140s, and we sell it up at 160. So down here in the 140s, it's actually it's actually a reasonable place, John, to actually to pick it up, and it has a yield on that of
4.3% right now on my screen.
Yeah. So that would be my recommendation. John, I also had. We have investors in our portfolio from their 20s, and I actually have one gentleman who just celebrated his 93rd birthday.
Yeah.
And he's involved in the technology space. I always recommend to people, if they're sort of in their 40s, you should have, you know, the tech space, just the vendor side of technology accounts for about 25%, a quarter of the marketplace. And I always say, as you go every decade higher, you should shave another 5% off. And so our 93-year-old gentleman actually has a 5% position in his portfolio in technology. I think everyone should have a portion, but based on, you know, what their investment needs and goals are, that's what I'd recommend.
Okay, we're going to take a quick break, and then we'll return with Kim Bolton, portfolio manager of Black Swan Dexteritas. He wants to answer your questions about technology stocks, so give us a call. It's toll free. 1-855-326-6266. We have Nick in Pickering on the line. What's your question, Nick?
Thanks for taking my call. I'd like to ask about Arista Networks and what's your position on it, and what's your 12-month outlook on this stock? Thank you.
All right, Arista Networks up 81% in the past 12 months.
Yep.
Where does it go from here?
We did own it. This, again, was actually brought to our attention from our investment committee, and there were these retired Cisco fellows. And so this goes back like 4 years ago. And it's currently trading, around $270. If you go back 4 years ago, it was trading down about $70. So we actually rode it from 70 to 150, paused, actually picked it back up at 190. We let it go just around 240. We don't own it right now. Our 12-month target was actually around 280. And so we will look to buy it somewhere south of 240.
All right, the street pretty much has the same view as you. The analysts who follow a 12-month target price of $279.56 is only 3.5% upside from where we are right now. Yeah. Got Robert on the line from Toronto. What's your question, Robert?
I wanted to get your guest recommendation on a Canadian-listed company that would benefit from the advent of the 5G technologies, other than the three big cell phone carriers. And he doesn't have one in Canada, then I guess in the U.S.
All right, so excluding the three big telcos, including the parent company of us, any plays in Canada?
Other than the service providers, no. Robert, though, you're thinking the right angle. 5G. According to Gartner Research, which is the world's largest technology research company, we have a full subscription with them. We use them for learning a lot about new technologies. Anyway, as they say with the 5G, by 2026, the 5G business is going to be a $1.26 trillion business around the world. It is huge. The problem is for the service providers, they have to invest so much money, and it takes a long time to actually get those returns back. The way we approach the 5G, Robert, is looking at what we call the arms dealers. It's the people that are the companies that are actually selling the equipment to the servicing companies out there. Celestica would be a great example. Certainly Cisco on the networking side of things. Robert, I'd look at the equipment suppliers in that space.
Okay, interesting advice. Sort of like in mining, right? You want to be the guy who invested in the picks and shovels.
Exactly.
Not so much the guy who has to pay for the hole in the ground.
Exactly.
Some people think that way about mining. Stephen in Vancouver is on the line. What's your question, Stephen?
Thank you for taking my question. It is on a Qualcomm. Would it be a good choice for income and as well as for safety? And if you can tell me a little bit about the prospect. Thank you very much, sir.
Right,
and may I have the market consensus, please? Thank you.
Sure thing, Stephen. Qualcomm got a yield of almost 3%, so there is some income there.
Yep. Stephen, thanks very much for the call. Qualcomm, we have about a just shy of 3% position in Qualcomm. Again, it's a leader. We look for those themes and then the trends and then the leadership. And Qualcomm, you can tick all those boxes. It does have a decent dividend on it. But then you have a bit of a lottery here when it comes to NXPI. And Qualcomm went to buy NXPI. It's being held up over in China. It's all enwrapped within this whole trade dispute. So actually what we did is we bought an August, during this trade dispute, Qualcomm came down, and ZTE, the Chinese one, came down. It also pulled down NXPI, which is again an equipment supplier, was into the The reason that Qualcomm wanted to buy NXPI is because they have leadership within the electrification and autonomous driving ecosystem for sensors and for GPUs and so on. So we actually bought an option. When I think NXPI is trading right now around 106, if you can buy an option of, and the strike price, or the price that Qualcomm has said that they want to buy NXPI is for $127.50. So if you can actually buy an option going out 2 or 3 months on NXPI, that's where I'd also add to your Qualcomm position.
All right, interesting strategy.
Hopefully that made sense to you.
For those who play options. We're going to be back with Kim Bolton, Portfolio Manager of Black Swan Dexteritas. Wants to answer your questions about technology stocks, so give us a call. It's toll free. 1-855-326-6266. We have Gary calling from Stansted, Quebec. What's your question, Gary?
Anyway, thanks, gentlemen, for taking my call. I'm concerned a little bit about Google. It hasn't done a whole lot, but I'm more concerned about technology stocks in general, how they might be affected by tariffs. Obviously, there's something that Trump said about technology robbing and such. But anyway, Google is one of the biggest. Alibaba is something that they have over there. Which would you think would be a better stock in some ways to have? I think Google probably could be, because it has the American influence and it is the biggest search engine for sure.
Yep.
Just like your opinion on that.
All right, Google versus Alibaba. I love a showdown.
Thanks very much for the question, Gary. We own both. We got 3.5% positions in both of them. Why? Exactly why you, as you cited, Gary, because of the leadership. Alibaba has a leadership over in China, and Google has the leadership in the Western world. If I remember correctly, Google's search engine actually, when you look at their whole revenue stream that comes into Google, it's just slightly less than 25% of their revenues comes from the search engine. But what they do is that they take that money and they put it into the other bets out there. It's that other bets section that, as they report, actually generates about 35% of their revenues. So it's using that piggy bank. They have 3.5 billion searches that go through Google every day. And this is why the advertisers, the advertisers online, depending on who and when you talk to them, they account for over 60 up to 80% of the ad dollars online coming through Google. So I would actually stick with both.
One for the Western Hemisphere, one for the Eastern Hemisphere.
Yeah, and just to answer your question about them being, I guess, Gary, it was 2 questions. It was about Google, what we think, but secondly is whether they're expensive, and third, the impact of the tariffs. Whether they're expensive, we look a lot. I used to manage a tech portfolio back during the dot-com period. Back then, it was just about vendors. Today, it's vendors, but it's also end users. About a quarter of our portfolio is actually made up of end users that have really embraced technology to make their businesses more efficient, more effective, to make more money. And there are some very, very strong companies out there that are doing it. Siemens is probably the poster child out there. But then there's Caterpillar, there's Boeing. You talk to the management teams of these big companies, they actually call themselves technology companies. Is it expensive? You can look beyond the vendors and actually look at the tech end users. Now, are the big companies expensive? To us, it's very different now because you have to look through the runway. everyone pays attention to their quarterly earnings and their guidance going out over the next a quarter or 2 quarters or 3 quarters. To us, it's all about that runway that extends out. And for example, how Google is actually using their great returns coming out of their search engine, for example, into YouTube. And how YouTube is being used as a platform, for example, in gaming. You know, there are 2 big, well, there's 2 big streaming platforms out there. One from Amazon, which is Twitch, and the other one is from Google, which is the YouTube. So it's how these companies are actually extending the runway, and Gary, you just need to look past that. Lastly, on the trade issue, you know, $35–50 billion in tariffs that Trump has imposed on the Chinese, and they have done likewise. In the big scheme of things, it's sort of nickel and dimes. And that's the way the market actually looks at it. It's big money for us, but in the big scheme of things, it's sort of nickel and dimes. What you have to do is watch whether it starts to excel into the 100, 200, 500.
That's when it starts getting serious.
So that's why the market has really sort of shrugged it off.
Going to be back after a short break. Top picks coming up next. It is time now for top picks. Your first one is Red Hat. What do they do and why do you like them?
Thanks, Rick. Red Hat. What Red Hat does is it enables customers to operate in what they call the hybrid cloud world, which is like the physical, the virtual, the public, and the private cloud. And you know, this big movement toward the cloud, and they actually hold the hands of customers to actually take that leap of faith. You know, what are the catalysts for this? You know, it's obviously the cloud computing adoption. Red Hat is known for the Linux operating system. It's becoming more mainstream. And also, it's an open source system, which is becoming mainstream. It's a great opportunity because on June 22nd, they actually reported. So in the past, they've always had growth rates of sort of 22 to 25%. The revenue growth came in at 20%. They actually lowered their second quarter down to 14%, but they blamed it all on fixed income. I think they were just trying to moderate people's expectations because they've had such a great run. So it's a company that has great cash flow. It's a leadership and application development technologies, and we believe over the next 12 months it's got a 20% upside.
All right, that wouldn't be bad in 12 months. We talked about this earlier in the show. Your next pick is Twitter. It's 5% cheaper today after today's trading action.
And this morning it was about 11% cheaper. You know, this is the online news and social networking company. Catalysts of growth is, you know, they have their viewership. Mr. Dorsey runs 2 firms, Square and Twitter. Both have done very, very well. We believe that the marketplace is actually undervaluing the growth rate, and so a lot of the analysts say, you know, last year they had revenues of $2.4 billion. They're saying going out to 2020, it's going to go up to 3.6. We believe that is actually undervalued. We see it sort of north of 4. They have a great ability to actually grow revenues beyond the estimates in the past. And just stepping aside, there's a lot of similarities between, you know, Dorsey and Steve Jobs. Okay. You know, they both left their companies, right? And then they came back. And then who they compete against. You know, Apple competes with Microsoft. What did Microsoft run into back in the 90s? It was that privacy issue. And so the same space that Twitter is playing in is with Facebook. And what did they have a problem with was the privacy issue recently.
I hate to rush you along, but we need to get to the last one.
Yep.
Activision Blizzard, the makers of Pitfall and River Raid.
Yep.
From the 80s.
Catalyst for this is all about mobile deployment, esports, streaming, geographical distribution. They have 30% of the revenue coming from mobile. They have that Call of Duty and World of Warcraft. They actually came out with this new thing called the Overwatch League. Which is, we were just talking in the break, where people actually watch teams play.
Watch other people play, yeah.
And so this Overwatch League, Robert Kraft, the owner of New England Patriots, actually bought a team on this.
Really?
It has a great runway.
Great runway, Activision Blizzard. Great having you here, Kim. We probably could have went 2 hours, but our time is limited. Thank you for joining us, and as always, consult a qualified financial advisor before you make any investment decisions. See you tomorrow.